All right. Good morning, everybody. Thank you so much for joining us and for filling out the poll that we've put up there just to get a feel for where everyone's starting with us today in this conversation. I'm excited to have you all joining us for a discussion about financial hygiene for investment preparedness. So thank you again for joining us today. Let's see here. Just for a bit of an overview of what's going to happen over the next hour, just to introduce myself, my name is Melissa Rouse. I am the Communications Director for Food System 6. I am joined by two speakers from the FS6 mentor community, David Guendelman, the founder of Do Good CFO, a company that provides virtual fractional CFO support to social enterprises, and Peter Herz, General Partner at First Course Capital, FS6 co-founder and our resident business Yoda. So they will both be spending some time with you today talking a bit about how to get your back of house in order for your business as you start to think about raising money. Before I hand off to them, I am going to give you a little bit of an overview about the FS6 work, our upcoming programs. Then we'll head into conversation with those two and then open up for Q&A. At the end of that, we are going to be doing the last 10 minutes or so of this conversation focused on allowing for questions and conversation about the upcoming FS6 program. If you are an interested applicant or an entrepreneur who's curious about learning more, please stick around to join us for those last 10 minutes. If you are just here for the webinar component, please feel free to hop off at that time and I will let you know when that happens. So heading into just a little bit more about us. So Food System 6, if you have not come across us in the past, we are a nonprofit business accelerator designed to support food and agriculture entrepreneurs. We're building a more resilient, inclusive, and vibrant food system. The FS6 Accelerator program supports impact-driven startups by building bridges between founders and the resources that they need to increase their impact and scale their business. Whether that is communication support, financial acumen training like we'll be doing today, one-on-one connections to our mentor community, and networking opportunities within and across our teams and portfolio. Let's talk a little bit about impact. Unfortunately, as we all know too well, the word unprecedented has become a big part of our daily vocabulary recently. With unprecedented events like the snowstorms we're seeing across the South right now, increasing in frequency, we are faced with the urgency and complexity of the challenges we are all working against. So while our hearts go out to everyone who is struggling with those challenges this week, I hope that everyone is staying warm and safe and healthy and as happy as can be. I just want to give a bit of an overview around why that is important for Food System 6, how this is important, and how we are thinking about impact within our programming and program selection. Food System 6 focuses on our 4 core pillars of impact. By focusing on healthy people, we want to make sure that the innovations we are working with recognize the interrelationship between the food system and the people that support it along the way. We focus on working with companies that promote healthy, sustainable, and vibrant farms by prioritizing the health and safety of farmers, farm workers, and farm animals throughout their lives. We work to promote sustainable ecosystems by supporting innovations that protect and improve soil, water, air, and energy quality by reducing or eliminating contaminants and protecting biodiversity. And last but most certainly not least, FS6 strives for a more just and fair food system by supporting innovations that decrease food insecurity, protect the rights of workers across the food supply chain, and affirm diversity. If this sounds like you, I have some exciting news, which is that we are currently running our call for applicants for cohort 7. FS6 will be selecting 6 to 8 companies to join us for our upcoming program, which will run from April 5th through July 2nd. We support all entity types, so for-profit, nonprofit, co-op, some other creative entity type that we have not heard about yet. We are excited to learn from and about whatever it is that you are doing. If that is something also that piques your interest, we do have one more webinar coming up in this series specifically focused on business entity formation and impact. That'll be on March 4th. So if you're curious about that topic, please join us then as well. This year's program will be virtual and will all be held in the comfort of your own home and will lead up to a culminating virtual forum event at the end of July. Eligible participants will receive a $25,000 safe note from our partner, First Course Capital, which you will see Peter is actually joining us from today, one of our speakers. If you have questions about that safe note, please stick around at the end and Peter can answer your questions about that as well. So I think with that, that is all you need to hear from me. I would actually like to hand the mic over to David from Do Good CFO, David Guendelman. Thank you so much for joining us. I think David is now going to give us a little bit of information about the work that he does, some tips and tricks and thoughts on how best to sort of prepare yourself financially for taking on capital as you grow your business. So thank you, David.
Thanks, Melissa. Yeah, pleasure to get to share a little bit with you all today. And I was watching the FS6 intro video, and which is a really nice short video about FS6. And there's a quote there where a participant says, "Mentors are not just a luxury; they're a necessity." And that really resonated for me. Most of what I know, I didn't learn at school. I learned from apprenticeship and from mentorship. And so I wanted to frame this talk by speaking about a key mentor of mine. In 2004, I co-founded a fair trade, artisan, gift, and housewares company called World of Good that worked with artisan producers all over the world, scaled nationwide in Whole Foods, and did a partnership with eBay, and ultimately got acquired by eBay in 2010. And as co-founder of World of Good, I was lucky enough to work hand in hand with our CEO, Priya Haji, who Van Jones called the best social entrepreneur of our generation. Priya sadly passed away in 2014, but along the way, she touched a lot of people and inspired a next generation of mission-driven entrepreneurs. And I learned a lot of Priya lessons that I'm going to try to channel today. The first thing Priya would say to you is, don't be incremental. Dream up a solution that's the size of the problem. So as entrepreneurs in a vast, broken food system, we have to dream big to solve this problem. And I really want to commend the FS6 Accelerator program, which I'm getting to know, and all of its entrepreneurs, some of which I've worked with, who are really dreaming big around how we grow, produce, and distribute food. And I know many of you on this call are doing the same. Priya would say the best ideas are still out there. And if you're watching this and you have a way to solve a problem using business or technology or a creative approach, don't just sit there and don't doubt yourself, just try. Since World of Good, I've worked as a fractional CFO and financial advisor to cutting food systems innovators. As an example, I've worked for over a decade with Carol Levine and Ken Lee at Lotus Foods, who are revamping the rice supply chain and the way rice is grown globally, and have scaled incredibly over the last decade. And that's one of a few of the food systems change innovators that I've been working with over the last decade. So in this talk, I'm going to weave lessons that I've learned over 2 decades of social entrepreneurship, fractional CFO work, and from my mentor, Priya. Priya always said good business executives are T-shaped. That means they have depth in one functional area and breadth across many areas. And I've always strived for this. When you're hiring up your teams, it's something really to keep in mind. So for a CFO, that means being good at finance, but it also means knowing enough to be dangerous in other areas of business as well. And so with that in mind, as a frame for our talk, for this talk, we'll start at the top of the T, and then we'll drill down and get really specific into some financial areas. But I think it's important to start kind of more broadly than that. So I'll start with a few principles I've learned along the way around entrepreneurship. They tie to finance, but number one is I'm a huge believer in lean startup principles. You launch with a minimum viable product, you test product market fit, you get feedback, and you iterate. you bootstrap for as long as you can. At World of Good, we were in a basement for 2 years, paying ourselves next to nothing, won business plan competitions. Carol and Ken at Lotus Foods have been incredibly scrappy and have maintained mission control and not given away their company as a result. Number 3, you start off by going for a niche and growing from there. So you find a high value product where there's few competitors, you be the best at it. At World of Good, we partnered with eBay, and I always remember the lesson that eBay actually started one of they really cornered the market on Beanie Babies. And then they moved on to the next thing and cornered that market, and then the next thing. And I just think I've seen that work time after time. Number 4, first get your unit economics right and then scale, not the other way around. Some people say, hey, we'll lose money on every sale and we'll make it up on volume. Well, it doesn't really work that way. So you need to figure out early on, can you sell a unit profitably? Can you get your top customer to be profitable? You want to prove things at a smaller scale. One of my, I've worked with a bunch of companies that haven't worked, and one of them tried to scale way too quickly. And I learned a lot from that. You have to first get your unit economics right, and then you scale. 5th is another Priya lesson, which is build your team with folks who have IQ and EQ. Life is short. You work hard. You want to work with really good people who inspire you. And so EQ matters just as much. So, next is the importance of hiring up in key areas of the company. So you can't be good at everything as an entrepreneur. Know what you're good at, and in areas where you're not, try to hire as seasoned and veteran leadership as you can in key areas. So I think sales, for example, is a key area, and you can hire more and more. You can hire fractionally. You can hire a fractional head of sales. You can hire, like we work, a fractional CFO. Okay, so now what about some tips that are specific to social entrepreneurs, specific to finance for social entrepreneurs? My first tip is, I call it no margin, no mission. And what I mean by that is that as social entrepreneurs, we're heavily focused on our impact on employees, on suppliers, on customers, on stakeholders. And it can be challenging to switch into a financial paradigm and make difficult choices like, cutting product lines or adjusting your org chart. But we have to keep in mind that healthy profits and cash runway are fundamental to ensuring that our business will survive and be around to continue fulfilling the mission. So you got to hold the margin alongside the mission and think about both. Okay, so now what do entrepreneurs need to be thinking about before raising capital? One thing I'll say is, investors are busy. Peter as an investor could speak to this after me, but the investors are looking at a lot of deals. They're raising money themselves. They're board members of portfolio companies, and investors, like it or not, they take the path of least resistance, just like we all kind of do. And so you don't want to make them do the work. You want to package up your offering so that it's easy to digest. What's the business opportunity? What's the financial plan? What's the clear story on impact and growth? What are the deal terms? And the hardest is to get your lead investor. Once you have that, you've built some momentum. But again, a lot of companies try to outsource this to investors, and it usually doesn't work. So you have to do as much of the legwork as you can. Here's another thing Priya would say is know yourself and what outcome you want. This will help you determine what investors to go after. Are you building a lifestyle business? Are you targeting, building and selling it where it's harder to maintain mission, but there's more financial upside? Are you building a steward-owned company where there's some kind of structured exit at the end and you want to ensure mission control? And if you know what you want for your company, you can find investors who are aligned with you. Capital in the mission-driven space can roughly be divided into two kinds, and this is a very broad split. Obviously, there's a wide spectrum, but it could be divided into two types: impact-first investors who are willing to concede on return in exchange for impact. So they're more philanthropic. They're not philanthropic completely, but they more tend towards the philanthropic side. And finance-first investors who are typically seeking market-based returns, but they also have a focus on mission, but they're not willing to make a real sacrifice on returns. That's not, and they have already marketed their fund to their limited partners, so they don't, they have to stick to the goals of their fund. They can't be philanthropic. The majority of impact investing is in the finance first area. And with these, with finance first investors, you really should be thinking about it being like a 5 to 7 year sprint after you've raised the capital to get the company scaled up and sold. That's the typical time horizon that they're looking at. With impact first investors, it's a smaller portion of the impact capital pool. It's probably about 10% of the total pool. It's still about $1 billion in impact first capital. There's a longer time horizon to exit. There's less of a focus on kind of an M&A exit event, selling your company. There can be structured exits, and there's more interest in preservation of mission and voting control remaining in the hands of key stakeholders. And stakeholders can be defined in different and interesting ways. It could be the entrepreneur and founders. It can also be, suppliers or customers or what have you. So when you go out for capital, these impact first investors, they are especially going to want to understand your impact, who you're serving, who benefits if the business is successful. So very important to kind of keep that spectrum of investors in mind and probably focus on targeting one. There are some businesses that can kind of try to target both, but typically you're better off if you kind of double down and go in one direction. So are there common mistakes that I see as CFO? The biggest mistake is waiting for a crisis to think about solid financial management. So what do veteran CEOs do? They invest in strategic financial management rather than react in crisis. And by doing this, they build investor confidence. They optimize profitability. They create a metrics-driven management culture. They get visibility into how much cash and runway they have, and they really avoid emergency capital raises. And emergency capital raises they suck the energy out of your business. It really is a real diversion. Okay, so how do you get started thinking proactively about financial management? I covered kind of the top of the T and started to drill down, and now we're going to drill down even deeper on some specific financial tips. So these are financial tips that are relevant to early stage businesses and social mission-driven businesses for sure. Number one, know your cash burn rate and your runway. How much are you burning? How many months of cash do you have? This is really key to enabling solid decision-making, and you should have a good financial model to help you assess burn and runway. Number two, cash is king. It's not just about your P&L, it's about your cash flow. And so you have to understand your balance sheet, and you have to understand your working capital. Most companies that in the food system area that aren't kind of, tech or software platforms, you are going to have inventory, which is going to be a huge driver of your working capital and your cash. And of course, there's AR and AP and, debt that you have as well. And, if you manage these well, they can get you through really tough times. If you don't, they can cause real crisis. And Lotus Foods is an example where we had some really good forecasting get us out of some very dicey situations. So it's really important. I suggest you check out FS6 has a free spreadsheet on managing your short-term cash runway, which is a good place to start. There's a lot more to do, but that is certainly a really good place to start. Number 3, capital raising requires lead time. Typically, you need at least 9 months to prepare, launch, and fund a capital raise. And so that's where strategic financial planning comes into play. By having a longer term financial outlook, you will make sure you have enough time to raise the capital that is strategically and mission aligned with what you want and what you're going for. Number 4, reforecast frequently. Quarterly is good. A budget is only as good as the assumptions behind it. And let's face it, times change fast. We're in a very volatile macro economy right now. And so we recommend quarterly reforecasting to give your team the tools that they need to manage the business. Number 6 is models aren't just for investors. A lot of times entrepreneurs think that they are. In fact, a really good model is for managing your business. So you should have a sales plan in there, and your model should be helping you to manage your sales team to their targets. You should have an inventory purchase plan, and it should be matching your sales plan. So you have just the right amount of inventory, and it should be helping you decide how much inventory you have. So there's a lot of, and there's many more areas, but there's a lot of areas where your model should be helping you manage your business. Number 6 is it's really important to get a good bookkeeping service. I recommend a service as opposed to a person. The service can really scale with your business as your business scales. I have a recommendation. There's a company Do Good CFO has worked with for 5 years. It's called Scrubbed. I'd be happy to connect you with them if you reach out to me or to the FS6 folks after the talk. Number 7, be transparent with current and potential investors. Esther Park, who's an awesome regenerative ag investor that knows the FS6 folks very well and who I've worked with for many, many years, she said, look, the best entrepreneurs tell me as an investor ahead of time about the risks they're facing, not after the wheels have fallen off. And Esther says, that these entrepreneurs, they're overly transparent with her to the point of telling her things she doesn't want to know. She's like, but I'd rather be hearing about all the little extra details than the other way around. Okay, so when do you know it's time to bring in outside finance support? I think first, everybody should start off by getting a great bookkeeping service, as I said. But there are a lot of questions a bookkeeper can't answer. A bookkeeper isn't going to build your forecast. They're not going to help you raise capital. They're not going to be able to help you evaluate new opportunities. And so when you have enough complexity in your business, either driven by kind of the investors or your capital stack, or by having a lot of SKUs and needing to model sales and inventory to ensure sufficient cash, these are the signs that you're starting to get towards kind of needing a CFO or having CFO capacities in your business. And you need to do this well before your business needs a large capital infusion and before crisis hits. For a lot of businesses, that starts to happen around 500K in revenue and can kind of go up to about 10 million in revenue. By 10 million in revenue, companies can usually afford to bring a full-time finance, kind of veteran finance person in-house. So how can a CFO help? They can increase your success in raising capital. They can help you design a profitable business model. They can help you scale while limiting mistakes and surprises by having a veteran who's been there. They can help build a metric-driven organization, optimize cash management, raise capital aligned with purpose, increase the likelihood of refinancing or expanding your capital stack, free up the CEO to focus on scaling, build credibility with investors and lenders, and increase your probability of successful exit. The FS6 team asked me specifically to speak a little bit about what makes Do Good CFO unique. At Do Good CFO, we work only with best-in-class social entrepreneurs, and these entrepreneurs know that financial sustainability needs to be built into the DNA of their organization. They want the expertise and availability of a CFO, but they don't need someone full-time. And Do Good CFO. It's myself and a team of associate CFOs. It's sort of like you're getting a CFO plus a controller plus a demand planner who's looking at your sales plus an analyst and veteran entrepreneur advice all rolled into one, and in a fractional way, which makes it more right-sized and affordable for your business. We go really deep in with our businesses. This is our 11th year with Lotus Foods. We're still working with them, and they've actually way outgrown 10 million in sales. We're part of the management team. We stay on after the capital raise. We're not just building you a pro forma model and walking away, which gives investors confidence that there's financial acumen in place for the long haul. And many investors who've worked with us on multiple deals, like Kate Danaher, who is the head of lending at RSF Social Finance, see it as a risk reduction if Do Good CFO is on board. So coming to the conclusion, Priya would say, know yourself, your strengths, your weaknesses. Don't be afraid to share your vulnerabilities. Find great people whose strengths complement you. And Do Good CFO as a boutique firm that only works with mission-driven clients and has a unique ability to dig deep is one way to do that. In closing, I want to acknowledge the difficult challenges that FS6 companies and entrepreneurs like you are taking on in the food system. And I want to applaud you for your courage and your perseverance. Priya would say, I think the greatest fear that all of us have is to fail. And the best relief of that fear is to fail. Because once you fail at anything, whatever it is, what you realize is that on the other side, you're still breathing, your heart is still beating, and you're just going to get up and dust yourself off and do it again. So don't be afraid to fail. Fail hard, fail fast, and that will be the thing that frees you. So with that, I'll pass it back to Melissa. So thanks.
Thank you, David. That is great. I feel like I was frantically taking notes, a lot of great information in there. So thanks again so much for sharing that. I'm just here to be the pass-through and hand the mic back over to our next speaker, Peter. Speaking of impact investing and bringing in that other perspective, Peter is a serial entrepreneur, investor, do-gooder, problem solver. So he's got all sorts of wisdom to share. So Peter, take it away.
Thanks, Melissa. You're too kind. I'm not sure I'm a do-gooder. I try not to make things worse. That's my starting proposition. So I'm a general of First Course Capital. We're an early stage venture firm investing at pre-seed and seed level, typically, in entrepreneurs who are building innovations that'll improve the food system. Basically, our view is that our food system is killing people and killing the planet. Otherwise, it's great. So we need to figure out how to address that. As David mentioned, there are a lot of pieces that you need to focus on as you build a business, and he covered a lot of ground, and it's all really great advice. I want to highlight a couple of those things with the investor's perspective. And maybe first, David mentioned that investors are busy. And I think a lot of entrepreneurs don't realize that a typical VC looks at 200 to 300 companies for each investment they make. So when a VC passes, that's not an issue. You're going to get a lot of investors who say no before you find anyone who says yes. I wish I could say, in my years of being on the entrepreneur side, that there's any way to logic out who will be excited about your business and who won't. But it's really hard to figure that out. And it seems to be in somewhat affected by how the markets are doing the day you happen to talk to an investor. It might have to do with what they had for breakfast or what they're planning to do for dinner, or what particular element they happen to see in your business that they recognize from something they'd invested in previously. And so it's very hard to logic out. So just be prepared to hear a lot of investors say no, and don't view that in any way as an issue. If you can, ask why people are saying no, and take that feedback and learn if there's something to be learned. But often, it's more about the investor and their, what they're thinking about, and not really about your business. So you have to, integrate that feedback carefully. So I also, want to reinforce the whole idea of no margin, no mission. It's really crucial to be able to successfully have an impact. You have to build a business that is able to endure over time, and that means having margins and having a business that can work financially in addition to working for impact. As an impact investor, and I'm going to give you my perspective on impact, and as an investor, it is not everybody's perspective. In particular around metrics, and I want to spend a few minutes just to talk about that. I'm not a big fan of having a lot of metrics that aren't things that you are measuring in a way that is integral to your business. And I think it's one of the hazards of working with impact investors. They start giving you a longer and longer homework assignment. And if it was just once when they made the investment, that would be one thing, but usually they want to have a continuous measurement and tracking of things. If it's stuff that you are tracking anyway, I think that's fine. But you want to the extent that you can, work with investors that understand that everything they ask for is going to be a burden on your business if it's something that you aren't already doing as part of the work you do. So that's just one investor's view on the metrics and measures that are used out there. I want to also spend a few minutes talking about cash management. And David talked about this, and it is really important to track it. Once you have professional investors and they are on your board of directors, the most important thing is not to surprise them. You want to, I had a manager many years ago who always made it clear, never fail alone. So don't try to, single-handedly solve problems, particularly around your runway and your cash, because that's only going to be something you can solve with the help of investors. And you already have some people that are in the company, and presumably they're in the company because they believe in the business and the mission and you. And so you want to really enlist them in helping you when you run into problems. And so it's super important, therefore, to know when you're going to be heading into problems and to have advance warning so that you can make changes. You can seek the assistance of your board members, investors, advisors to help you avoid getting to cash zero. And I think it's a really important thing when you run your business. You will, as David encouraged you to have a bookkeeper or a bookkeeping service. I think that makes a lot of sense. But what that's doing is making your financials from a historical perspective look the way they need to look, and so that you can understand what happened in your business in the past. Unfortunately, those books don't really tell you about the future. Mostly companies are do accounting based on the accrual method. And that actually is a better way to understand the history of your company and how money was made, how it was spent, where it was spent. But it doesn't actually tell you what's happening with cash. And you really need to know what's going on with cash, because for a startup, it's pretty simple. You get to cash zero and it's game over. And a really simple example, if you haven't run into this difference between cash accounting and accrual accounting, really simply, if you buy an insurance policy that's good for a year, and let's say it's $12,000, just to make up a number, that might be accounted on an accrual basis as $1,000 a month over that year. But that's not what happens with the cash. What happens with the cash is you bought the policy at the beginning of the year, and you're out $12,000. So it's really important to recognize that distinction and have a cash forecasting tool that doesn't take into account this accrual approach, but actually looks at what's going out of your account, what's coming into your accounts, and will you ever get close to being at cash zero? And so one of the tools that FS6 offers is a Excel workbook template that lets you build a 13-week rolling cash flow forecast. That's a really useful tool to just track what you anticipate happening in the future. Because again, what happened in the past doesn't really matter. It's what's happening in the future and when are you getting low on cash. And David's recommendation, either at a quarterly or maybe a monthly level, just making sure that you've got at least 13 weeks of cash in the forecast, that you're not going to get close to zero in that time frame, then you're fine. But if you see that you're going to get into a cash squeeze within that 13 weeks, then you should be tracking it at least on a weekly basis, and you should start having those conversations with others who can help you avoid getting to cash zero. One of the things to keep in mind, another thing that people don't really pay attention to is that when you have a payroll, you're typically paying the payroll in arrears. And what that means is if you are cutting paychecks this week, the payroll period actually that covers started 2.5 weeks ago. And what that means is when you think you're getting to cash zero, it may actually be a lot sooner than you think. So you have to keep that in mind as you build this cash flow forecast, that you can't actually enter a payroll period that you don't have the money to pay for. So you have to be aware that there's like 2 to 3 weeks, depending on what your payroll cycles are, that you need to know exactly when those payments are due relative to when they're owed. I'll just add one thing to that. There's, I think, a temptation to defer payroll if you don't have the cash to pay it. That is a really dangerous thing to do, for a couple of reasons. One is the government actually doesn't care if you pay your people. So, you can not cut checks to them. But if you don't pay the payroll taxes that are due, then they will come after you. And every officer and director in the company is jointly and severally liable for this. And it is, so heinous that you even filing for personal bankruptcy will not limit the liability of this payroll tax that is incurred in a company. So what you want to do is, just adjust people's pay. Tell them you're paying them either half or zero. Make the adjustments with letters to the employees that you put in their HR files, and pay them what you say you're going to pay them. Do not do deferrals. Don't. You can obviously once you get through a bad period, you can have a conversation with your board or your investors, whoever there is, and say you'd like to do some additional equity grants to maybe compensate for what happened in the past, or maybe some bonuses in the future. But you don't want to make any commitments like that, and you don't want to say that some equity is in lieu of pay, because again, the state gets really interested in that, and they'll do surgery on you to get paid. So enough of that. Another area that I think is worth just a couple of minutes is in planning your financings. One of the things that I think entrepreneurs don't pay attention enough to is, in addition to the amount that you're raising from investors, what really matters is what are the milestones that you are going to achieve with that money. And it's really important to make those milestones achievable, and not only achievable, but with enough additional time to raise the next round of money after that. And just as David was describing, it takes time to raise rounds of funding. So you want to make sure you've got the runway to do that. As an investor, I can say this: investors don't know shit. So if you tell an investor who's leading your financing that you're going to achieve $1 million in revenue as one of the milestones with the money that they're putting in, and you only achieve 800K, then you failed. You failed, and it's because of what you said to your investors. On the other hand, if you tell them I'm going to hit 600K and you actually achieve 800K, then you're a hero and a genius. Keep in mind, in both scenarios, you did 800K in revenue. The question was what you told your investors. So what you want to make sure is that you basically, when you define your milestones, you're basically handing a baseball bat to the investors to beat you over the head with when you don't achieve your milestones. So what you want to do is make those milestones, make it a toothpick, and that's all they can beat you over the head with, instead of a big baseball bat. So you want to set those there's another tool that FS6 offers, which is an Excel workbook that lets you lay out your financings, not just for the round you're currently raising, but for the next several rounds. And using that tool, you can start laying out, what are the milestones you need to achieve, and what valuation does the company get out to, and does that ultimately align with what your kind of company should look like going out 5 to 10 years. And what that does is it helps you sanity check not just the current round of funding, but several rounds in succession. So that's a useful tool to go through this exercise and not just define the amount that you're planning to raise in each round, but also what are the milestones that you're planning to achieve. There's another piece that I will maybe spend 2 minutes on that's around financial hygiene, but from a slightly different perspective. And that is keeping track of all your contracts and agreements. This is something that a lot of entrepreneurs don't even know they need to do, because when you're raising money in a form of a safe note or a convertible note or friends and family type of stuff, you don't need to worry about this. But when you get to a priced round financing, you're going to have to deliver every contract and agreement that the company has ever entered into since day one. And that turns out to be hard to do. I personally can barely remember what I did last month, let alone what I did a year ago. So not having a place where you track that is a real problem. So another a tool that is available from FS6 is a material agreement log. And what you can do is just, track each agreement, and what that, lets you do is when investors, and it's their lawyers that come with this request, when they want to see every contract you've ever signed, you can actually give them this agreement log along with the agreements. And it can be sorted not just by, chronologically, but also by the counterparty and by the agreement type. And I was able in one company to go from a term sheet to money in 11 days. And it was in part because our contracts and agreements were so well organized. It really allowed investors' counsel to figure it out, and very quickly decide whether we looked like we were investable or we were not. So apologize for the background noise. I'm killing small animals here in the background, I guess. Last piece, and I think we're running out of time. So I'll just say, it's really important to know your numbers. Investors will want to ask these questions, not necessarily because the answer, the specific answer matters, but more that you kind of know your business well enough that you can answer things like what your revenue run rate is, or what your margins are like, or as David was saying, what's your cash runway look like? So these are all things that help investors get comfortable with the fact that you understand your business. So you want to be able to know those things and be able to be clear and definitive with answers, to help give that comfort level that you understand your business. And I think with that, I'll pass it back to Melissa.
Thank you, Peter. That's great. And I'm assuming that everyone saw it, but if you did not, I did drop links to each of those 3 template workbooks in the chat. We will also follow up with that information in an email, so you will have it all in the end. So now I'd like to open the floor for a couple of minutes of Q&A before we shift and talk about the program. But if anyone has any questions, please feel free to either drop it in the comment box, raise your hand, however you feel most comfortable having your question voiced. And I think we'll spend maybe 5 minutes on Q&A for this session to give us a couple minutes at the end. unless there are no questions, which means a job well done for our speakers. All right, let's see. That is a great question. Okay, so question coming in is how to avoid a garbage in, garbage out data management programs for startups. I don't know, Peter or David, if you have any thoughts on that particular topic.
Well, I'm not sure what the questioner is referring to. So I'd be great maybe to have a little bit of
More context.
Yeah, a little bit more context.
Yeah.
Yeah, I would say don't put garbage in. Just kidding. I also don't quite understand the context or what kind of garbage is getting created.
No problem. Kyle, who sent the question in, you're welcome. If you want to chime in and add any additional context, you're welcome to unmute and chat, or you can send additional context in the chat box and I can pass it along. Let's see, it looks like the additional context is QuickBooks pulls in data from Shopify, for example, which is just insufficient and vague. That's the example that they're specifically dealing with and thinking about. So is that integration there?
Yeah, I don't have a specific response to that other than you kind of have to troubleshoot, and if you have a good bookkeeping firm that has kind of technology background, they can quickly troubleshoot how to kind of block that garbage from coming in. Yeah, like I said, I work very closely with an organization called Scrubbed. I'd be happy to introduce you to them. Their website is scrub.net, and they are very strong in kind of creating these technology links to work well in troubleshooting any issues that come up.
I might just very quickly add that in my view, the most crucial metric for a startup is rate of learning. And when you are in the beginning stages, as it sounds like you are at the moment, you need to figure out what is it you need from your systems. What is the information you need to properly manage what's going on? And while your, the number of customers, the number of orders and everything is relatively small, because that's the case in the early stage startup land, you need to debug that and fix it. And as David was saying, work with people if you can't do it yourself. But it should all be based on, what is it you need to be able to run your business efficiently and figure it out.
Great, thank you both. I did drop the scrubbed.net link into the chat box as well, in case anyone is interested in exploring that further. Okay, new question coming in is, what are the valuable elements that you seek when you decide to invest in pre-seed propositions which do not have a financial track record? I'm thinking, Peter, that's a good one for you.
Yeah, so that's a great question. What I like to say is I really don't know shit. So for us, we really want to see some kind of evidence of traction, and we don't need there's not a minimum revenue line, but there's lots of people with lots of ideas out in the world, and it's very hard to tell the difference between good ideas and the other type. And the best way to do it, in my opinion, is to have some early customers, early evidence that there's something that makes sense, that people are willing to pay for, or whatever it is that you're building, whatever product or service.
Great, thank you, Peter. And it looks like there is a connection happening in the chat as well. Sarah, thank you so much for making that comment. Back to Kyle's question about that kind of linkage between the systems. If you haven't already, you can private chat each other to send contact information and make that connection to resolve that issue. Sounds like you're dealing with some of the same things. So that's always great to make that connect. I think we'll take, if we have one more question on this topic, and then I'm going to shift a bit and talk about the FO67 program. But any last questions for Peter or David before we free them back to the wilds?
I have a quick question. I don't know if you can ask this way or if it has to be in the chat.
No, go for it.
I'm wondering if you know a good way to do a pre-money valuation, or I guess a post-money valuation. Like, let's say you have started making some sales, but you don't really know how to like value your company accurately. There's like websites and stuff that will give you an estimate, but I don't really know how accurate those are.
So I can maybe take that. I have some thoughts on this, which maybe not every investor believes in, but here's my view. The pre-money valuation of your company is actually a calculated result. And what it is the result of is how big a check an investor wants to write and what percentage they want to own of your company. So you'll notice that has nothing to do with your revenue. It has nothing to do with anything in your company at all. So when you talk to investors, you can ask them, what's their typical check size? And you can ask them what they typically want to own of the company. And we don't really have time at the moment, I think, to go into why this is, but investors, when they invest in your company, the ownership stake they have at that first investment they make is the high watermark of their ownership stake. For various reasons, that's just how it works. So that's why most investors are oriented that way. And it seems a little weird, maybe even perverse, that the more money you raise, the higher your pre-money valuation is, because that's what that says. But that is actually how it works. And I used to think it was weird when I was an entrepreneur, but then I figured out that it's very hard to come up with a true value, pre-money value for a company that's either pre-revenue or early revenue, because there are no financial measures that make any sense. So it turns out you want to ask, how big a check is someone wanting to write, and what's their target ownership percentage? And then you can actually calculate the pre-money yourself.
I'll just add, I know we're almost out of time. I'll just add a little bit to that to say, number one, if you meant pre-revenue valuation, that's really tricky. But convertible notes and safe agreements, one of the great value of getting financing instead of like a priced equity round, if you can get a convertible note, is that you don't have to define that dollar amount. So that's, I really kind of prefer that as a vehicle for capital raising for early stage companies. If you're raising from angel investors, like VCs sometimes will go for that, sometimes not. And then the other thing I'd say is that I don't know what kind of company you have, there are different multiples that are the typical revenue multiple for in different industries. But for organic food CPG companies right now, the kind of median multiple is about 2 to 2.5x revenue. So if you're an organic food company and you just kind of want to have a general sense, I would say, start with that. Like if you're asking for more than 3 or 4x, that's very high. And if it's below 2, that's probably on the lower side. But again, it kind of depends on the business model.
Thank you, David. And that's great because that actually answered a question that came in early on about safe notes and convertible notes. So you got us a double whammy there without
Two birds
knowing
with
it.
one stone.
Yeah, exactly. So I just want to acknowledge that we are now at 11:02 and respect everyone's time. If anyone needs to hop off, you are more than welcome to do so. If you have questions that weren't answered about the FS6 program and you're not able to join us for maybe 5 rollover minutes, you are welcome to email us at fs6@foodsystem6.org and we will do our best to answer your questions. We also do have another webinar coming up, which will have an additional opportunity for Q&A. But if you do not have to hop off, I think we will just sort of open the floor for some program Q&A about our upcoming cohort, our call for applicants. I have some high-level details I can get into, but I think at this stage, given time, I just want to say thank you to our speakers. Thank you so much for all of your perspectives.
Thanks, Melissa. It was a pleasure.
Yes.
Really enjoyed it.
Great to have you on, David.
Thanks,
and I think,
Thanks, Melissa. It was great.
Thank you guys so much. And I will follow up with those workbooks and templates for everyone as well, so you can have those. And I'll give everyone a minute to sort of drop off. But if you have questions about the program, do feel free to drop them in the chat. And I will run through a couple of high-level programmatic details right now, just quickly, while we wait to see if any questions come in. And we'll try to bang this out pretty quickly. So just so everyone knows, for our cohort 7 upcoming program, we are looking for stage 1 applications to be sent in by March 5th. It is a 2-stage application process. So once you are, the stage 1 app is about a 10-minute application. It helps us determine if you are at the right stage, if you are a good fit for our program. It is meant to save you time by being this kind of tiered system. So if you have questions about whether you are a good fit for the program, if you are at the right stage of growth, if we can help you, I highly recommend just putting that stage 1 app in by March 5th. And if you are deemed a fit by our selection committee, we will send you follow-up information about the 2nd stage of the application process. And that is a longer application and will lead into our interview and selection process. But no harm in sending in that 1st stage if you have additional questions. Let me see, anything else beyond that? We are generally supporting early stage companies. This generally means seed or pre-seed if you are raising traditional capital. For nonprofits, that generally means you're within 3 to 5 years of formation. Like I said early on, we support all entity types. And for our core program, which cohort 7 is, we are working with US-based companies or companies who are working on a US market entry. So those are sort of the high-level eligibility questions. The program itself will kick off right after Easter and will end at the end of July with our pitch event. So that's my speedy run through of all of those pieces. And I would say, feel free to chime in with any questions. I see one coming in from Nancy as to whether you have to be a corporation to participate. The answer is no, although to be eligible for the First Course Capital Safe Note, there are some eligibility requirements there. Peter, I don't know if you want to speak to that.
Well, Melissa, I just want to add, I mean, you do have to be an entity. So, you don't have to be set up as a corporation to participate. You do have to be an existing business entity of some type, and, ideally have at least early stage customers.
Great, thank you.
Yeah, and then for the first course, one of the requirements is to be either organized as an S Corp or a C Corp. We recommend Delaware just because that, is the most investable entity there is. Any other answer to that question just creates friction for some subset of investors, which if you're looking to raise money is best to avoid.
Great, thank you, Peter. And Cesare, there's a clarification that sole proprietorships are not included in that, correct?
I mean, I think, that's sort of what we talked about earlier. I think that's it's a little bit to be determined. I think that it's certainly worthwhile to submit the stage 1 application. We are very interested, especially with cohort 7, at looking at, the ways that different entity types interact and interplay with one another. And I think sole props, definitely can kind of fall into that. So, I mean, if you're running a sole prop and it's a business that you're working on and thinking about how to, strategically grow, scale, I think it's worthwhile to submit a stage 1 application.
Thank you. Any other questions from our hanger honors? Thank you guys for sticking around. Feel free to just, unmute and chat now that we're a smaller group. Okay. I think that's it then. We're 7 minutes over. Thank you guys so much again. If any questions come up, do feel free to join us either for our next webinar, send questions to the fs6@foodsystem6.org email address. We do also have a very extensive FAQ on our website that goes through a lot of the questions that we are asked regularly during application seasons. So those should all hopefully be in there. And when in doubt, submit a stage 1. And I think a lot of questions are answered in that process. And like I said, is meant to be kind of a clearinghouse that is low effort for you, because we know you are busy because you are running and building a company. So I think that is it from us today. Thank you so much, everybody, for joining. Thank you, Peter, David, who I think dropped off already, the FS6 team. We really appreciate all of you joining us and hope to see you in our next conversation.
Thanks, Melissa. Great
Thank
to see
you.
everybody.
Thanks, everybody.